Our first panel discussion today is on artificial intelligence and systemic risk, and will be chaired by Andréa Maechler, as Pablo Hernandez de Cruz already introduced her, the Deputy General Manager at the Bank for International Settlements. Ms. Maechler will introduce the panel members, and let me remind you again, you can ask questions at the end of the discussions, and those who are online can submit questions via Mentimeter. So without any further ado, let me hand over to Ms. Maechler. Thank you.
Thank you very much. Let me start by saying it's a great pleasure for me to be here and to be moderating an amazing panel. So we know it, we feel it, we're working on it. The global economy is at a pivotal technological juncture. Embracing advanced AI technology offers the potential for great gains. We know that too, particularly for the financial sector. But to fully realize these benefits, new technologies need to enhance and not compromise financial stability. So this brings me to the themes of today's panel, which is AI and systemic risk. Now, as we were preparing for the panel, I was thinking, how do I frame an 80-minute discussion on this very broad topic? So before introducing the panelists, let me highlight, I thought it would be useful to highlight 4 concepts which bring out, or try to bring out, what is new about AI today from, say, the long-standing discussion we've been having on big data, on machine learning. What makes AI at this juncture special? Just to start framing the discussion that we'll have. So 4 concepts. First is the complexity of AI. What do I mean by that? It's the black box nature of AI, the inability to explain the forecast, to explain the outputs of the model. That really can make it much harder for supervisors, for central banks, to detect market dysfunctions, and also, of course, the buildup of systemic risk. So that is going to be really interesting to hear the perspective around how do they see the risk around this greater complexity of AI. Second concept, homogeneity, lack of model diversity. Right? We live in a world where we consume more data, we create more data, yet many of our AI models share all the same foundational models. So we know this clearly creates the risk of, although the results seem very tailored to our needs and questions, in the end they could provide a very homogeneous recommendation, i.e. the good old thinking of a recipe for herding behavior. Again, is the role for promoting greater model diversity. Second point, dependency, lack of resilience. We know it, the AI supply chain, from the production of chips to cloud computing, to data, to models, to applications, is highly concentrated. We know it from banking, too big to fails. We've gained a lot of lessons there about how do you increase the resilience. Another very important point. And the last one, speed. Right? AI brings tremendous speed. Speed is everything in financial markets. Speed can also bring new risk. So the question here is it time to consider speed bumps? So these are some of the concepts that our panelists are going to look into. So let me introduce them very quickly. I'll do a very short introduction. It's better to hear from them. So first we will hear from Iscenko. Iscenko will bring us an industry perspective. She's currently principal economist at Google. She's worked at Spotify, but she also has a policy background. She has worked at the FCA. So we very much look forward to hearing from you. Then we will go to Sudeep Kesh, who has prepared a game for us. I'm very excited. Sudeep is Chief Innovation Officer at S&P Global Ratings, and his work, he's been developing work on the digital threats, whether it's AI, whether it's cyber, so that will clearly bring a very interesting perspective. Then we will turn to Robin Lumsdaine, who's well known here. Robin is a member of ESRB's Advisory Scientific Committee. And she's also Professor of International Finance at American University School of Business. Robin, as I said it, well-known expert on systemic risk assessment, will bring, and she's doing a lot of work on large language models at the time. The beauty about Robin is she will bring together really academic with a policy perspective. So that is really going to be something very valuable for this discussion. And last, but clearly not least, is I will give the floor to Dirk Zetzsche. He will bring us the legal perspective. As we know, none of this can happen without a sound legal, regulatory, but particularly legal perspective. Dirk is a professor of law at the University of Luxembourg. He has a deep understanding of not only the legal, but also the regulatory challenges associated with AI, but also cyber and crypto. No, I think it's crypto. In fact, Dirk co-leads Luxembourg's National Center of Excellence in Research on Financial Technologies, what a mighty name, and is a member of ESRB's Crypto Asset Task Force. So, I will stop here with the introduction. As you see, we have really a broad range of view to discuss AI and systemic risk. Jean, you have the floor.
Thank you very much. Well, it's a pleasure to be back to my regulatory roots, I have to say. I started my career working on dealing with the global financial crisis, so that's a fantastic flashback. So I would like to start by just trying to define the terms a bit better, with a bit more color. So as a person in the industry, when I think about AI as something that I think might change the world, boost productivity, increase growth, help us be more productive, etc. I generally think of AI as an umbrella term for a range of technologies. There are technologies that significantly advance the statistics of prediction and or enable better automation of tasks that humans would normally do. So it's important to kind of step back from the recent excitement about the generative AI specifically, because obviously the technologies such as ChatGPT and Gemini and all of the other conversational AI tools have really captured the public imagination through the sort of accessibility. But it's important to remember that those are a subset of things that advanced AI could do. They are, and in fact, as an umbrella term, AI encompasses a wide range of very different technologies which have different algorithms going into them, different data, they have different outputs. They have different infrastructure needs in terms of how much computing power, etc. they need. And they also have very different financial applications. And as a result, the risks and opportunities of those technologies will vary depending on what you're talking about and where you're applying it. So it's really, really important to keep that broad perspective because the term gets used rather loosely. And for me, that also brings it to regulation, where I think it's really quite important to look at specific cases of what technologies are being used and what sort of financial activities they support and what the existing regulatory structures are around that. And then looking in that more narrow frame of specific context, like credit risk, for instance, will help, I think, regulators to identify more well-defined issues, to the extent there are some, and develop tailored remedies that don't risk throwing the baby out with the bathwater. So I think definitions and thinking about the big picture of AI use in financial services is super important. So on my second set of opening remarks, I think the audience here is quite well aware of some of the emerging conversation about the risks of AI for financial stability, and some excellent work has been produced by some of the people in the room on that. And I thought I'd reflect a bit on the flip side, if I may. So about how implementations of AI technologies in the financial sector or more broadly could help improve factors that we typically associate with financial fragility. You know, the complexity, the animal spirits, type of herding behaviors and lack of diversification. As an economist, I believe there are always two hands. You know, there are pluses and minuses. So, starting with complexity, one thing that strikes me is that, from my recollection of the previous financial crisis in 2008, even then we had black box models that people didn't quite understand, that blindsided regulators and industry participants. So that was already a level of mathematical complexity that humans couldn't quite engage with. So I sometimes wonder whether AI, these larger black boxes, make things substantially worse, or whether that's just a reflection of the persistent issue of explainability of any complex technology. But in terms of the positive side to the complexity, I was reminded of the speech that Andy Haldane of the Bank of England gave shortly after the global financial crisis, where he was talking about how a typical ABS CDO investor would have needed to read something like 30,000 pages of documentation, prospectuses and underlying contracts, to engage with both the actual asset and the underlying components. And then his team, I believe, estimated that it would rise to around 1 billion pages if you were talking about the CDO squared. So this is obviously completely beyond human comprehension. But it feels to me like this is one area where machine processing, obviously correctly tuned, checked for hallucinations, et cetera, has some hope of improving things considerably. There's some hope of distilling very large volumes of information into key trends and risks, and highlighting, for instance, unusual assets for further manual investigation. So I think that there are opportunities there for regulators and financial firms. On the animal spirits, I was this was something that struck me when I was recently in San Francisco and was having my first self-driving car taxi ride. It was pretty great. But it was, surprisingly to me, one of the calmest and most compelling, relaxing experiences I've had in a taxi in many years. That was a car that wasn't getting agitated in a traffic jam, wasn't weaving between lanes, wasn't slamming on brakes when something surprising happened. It was very orderly and measured. It was following prescribed rules, and the algorithm was kind of sticking to the rules and objectives at all times. So that made me think that we often worry about what algorithms might do to trading, for instance, but in some sense, not being subject to some of the human emotions and panics over exuberance, etc., could be a positive flip side that might improve resilience in the face of turbulent conditions. Again, this depends on how the rules are set for the system that engages with the market, but it was a surprising reflection when I was in that car. And then finally, on diversification, very briefly, I believe that it's commonly accepted that many a crisis have been caused by some form of over-reliance on mortgage lending as an asset class throughout history. But we know still that lending to other sectors of the economy is fairly stagnant. So there are good reasons for that because of the complexity, the idiosyncrasy of business, lending opportunities, etc. But again, I was wondering how these new technologies actually have a hope for making lending to other sectors of the economy more compelling and more attractive, and increasing diversification in balance sheets. So two very brief points on that. One, of course, business risk assessment is very difficult, and there are no credit scores, etc., etc. However, as we're now moving into the era of models that are capable of processing unstructured information, we might have a much better opportunity to make those risks measurable in financial sector. And secondly, we've already touched on the productivity growth that's expected. And of course, if that occurs, if other sectors of the economy become more productive, growth increases, that does have the potential of reducing risk given a certain rate of return, and again, making that sector more attractive. So there are things to look forward to as well as things to worry about, and I look forward to the rest of the panel talking about these.
John, this is a really interesting insight about thinking a little bit differently about AI and systemic risk. So in your view, in a couple words, how your plea basically is how can we make sure that we of course mitigate the risk, but while preserving the incentives for innovation, right? So what are the key principles for you that are needed to bring us there?
Sure, okay. $1 million question, and
30 seconds.
Yes, okay, so importance of the counterfactual. So we are not aiming for perfection in the decision-making that these models do. We have to remember that the benchmark is human decision-making and its flaws. So important to compare what we are assessing with what already is in place when thinking about risks. Even more so, context dependence. So we need to evaluate specific technologies within specific contexts, where they're being applied, and specific regulatory frameworks. We have rules for operational risk, we have rules for credit risk, we have systems and controls that might largely apply even if AI is an input. And it's important to kind of think through these contexts. And finally, education of both industry participants and policymakers. There is a lot we don't know. There's a lot to still learn. And as I said, there's a range of technologies with different characteristics. So it's really important that both the central banks invest in kind of upskilling in this, and also that you guys keep a check on the financial sector to make sure that excitement about the AI doesn't mean that certain technologies that are most exciting get used for areas which are not necessarily best suited for them. No pressure.
No, that's really interesting. Let me push even one step further, and I will actually ask maybe the input from a legal perspective, because you mentioned very nicely AI is not a simple box, there are different approaches. From a regulatory perspective, there are also very different approaches that have been used across the world, right? We know the US has had more of a market-based approach, China has had more state-based approach, and Europe a more societal rights approach. Maybe, Dirk, can you tell us a little bit what is the impact of having these different approaches? Where are the key gaps? And is there a role for or can international cooperation help here?
First of all,
again, 30 seconds, not easy. You'll be able to.
First of all, we all have to understand that we know nothing. Yeah, that's just the truth. So we deal with the issue of uncertainty in various ways, and some focus on data, some focus on the technology, some focus on the humans, and some focus on the capital inflow. Yeah? So we have entirely different approaches and speak about this, but they all deal with the issues of uncertainty, because AI means self-improving code. We don't know the status of the code after improving. Yeah? We know the state ex ante, but not ex post. So that is what we call black box. Yeah? And since we don't know what we're dealing with, all regulators try to understand more without killing the innovation. And I think that's a balance we need to somehow find in the end.
So no magic recipe here.
30 seconds.
I'm sure this is a great start of an answer. Let us come back to that, because I think it is very important, that uncertainty, because ultimately this is what it's about. It's how do we deal with uncertainty, and yet we can't wait too long. So yes, let me now, I think I want to go to Sudeep, who will start with a different approach, I think give us a different perspective on AI. why don't I just give you the floor?
Sure. No, absolutely. No, thank you very much. Why don't I stand so we can all play this together? And I'm going to pull on this thread, right? Because I'm, just for everyone's benefit, because I don't know a lot of you. I'm Sudeep Kesh. I'm Chief Innovation Officer for S&P Global Ratings. I'm really, really just floored to be here, and I'm really, really, filled with gratitude for the invitation. And I've been studying artificial intelligence for the better part of 25 plus years. I'm a little bit embarrassed to say, because that's the reason for many of these gray hairs. But I never forget that I'm a student first. So as much as I learn more and more about what I don't know. And I think that just kind of reiterates Dirk's point there. So I've just come up with a little bit of a game for you guys, which I call Head, Heart, and Hands. And it's really just, it's a simple game. You don't need any particular skills other than a little bit of imagination. But let's just get started. So the year is 1600. We'll do a little bit of time travel. The year is 1600. We're in England. What do you guys think the average life expectancy was? 30? 35? Any guesses? A little higher? 25? Oh, 45, okay. Higher or lower? 30 is it?
60.
So then if we fast forward a little bit, let's stay in England, so we'll reduce the geographic travel. But let's go to 1765. So life expectancy increased. I'll give you a hint. But what do you think it increased to? 31? 31, okay. Very small. De minimis increase. Any other guesses? 50. 39. So we had a 30% increase in life expectancy in 165 years. So let's, and we know, that it's increased dramatically since then, right? So let's work backwards a little bit. What was a major event? And in a room filled with economists and professionals of all types, right? So I think you'd probably sort of guess this. In 1765, what was sort of a major economic or sort of world-changing event happened? There's two inventions. Does anyone know what they are?
Electricity.
Say it again. The plow. Okay, good guess. So the two that I'm looking for are the invention of steam power. Yes, that is one of them. So steam power was actually invented about 20 years earlier, but it was largely a parlor trick. It wasn't used in any sort of industrial capacity. So right in the 1765, there's another invention of the spinning jenny. The spinning jenny was able to basically automatically make yarn and gave birth to the modern textile industry. Powered by the steam engine, all of a sudden we have the Industrial Revolution and modern society as we know it. Now 1600 is a little bit trickier. Does anyone know, and it'll stay in the realm of economics, does anyone know what happened in 1600? Any guesses? Printing press. Good guesses. That might actually be true as well. But the answer I'm looking for is actually the formation of the East India Tea Company. So the East India Tea Company was able to take the age of exploration. They were able to go to India and all of these places to be able to procure tea. Tea is a highly addictive substance because of the caffeine, but it's very much a luxury good in 1600. Once the East India Tea Company was able to sort of do their thing, they were able to reduce the price of tea to 1/2000th of the prior cost. That made it consumable essentially by a peasant in England was able to easily consume 2 cups. So now before we're talking about life expectancy, so let's think about what does tea consumption have to do with life expectancy? Any guesses? Boil water, that's the one. So to think that in order to invent things like the spinning jenny and the steam engine, someone had to live long enough, and eliminating waterborne pathogens enabled somebody to live long enough simply to invent the sort of raw material necessary for modern society as we know it, right? So that's why I think it's one of these things, going back to Dirk's point of, at the end of the day, we have to realize we know nothing, right? We have this very rational mind, but oftentimes we're not seeing a complete picture a priori or, in sort of current. So that's why I think it's important to really just, open up your mind a little bit and use sort of your rational brain to think about the data, think about these things. So let's go to the heart, right? So I'd like everybody to raise their hand as high as they possibly can. Now I want you to raise it a little higher. All right, you can put your hands up. Thank you. So what we just did was a bit of an experiment on our own sort of behavior and motivation, right? So when I ask you to raise your hand as high as you possibly can, that's extrinsic motivation. So in academic terms, that would be receiving something. I don't have a gift to offer you, unfortunately, or the absence of pain. I'm not going to hurt you, fortunately. So that's extrinsic motivation. But we also have intrinsic motivation, right? Intrinsic motivation gives us that little extra push, even though the request was to raise your hand as high as you possibly can. Everybody went a little bit higher when they were asked. You have that push. So we have to think about from the head as well as the heart. Now let's go to the hands, right? So I'd like everybody to raise their hands if they can draw. So how many we got? About 30, 40%? Excellent. Now I'd like everybody to raise their hands if they can sing. About the same? Yeah, 30, 40%? All right, good. They're very good. Now this is where it gets a little bit weird, but I would like everybody to just close their eyes for a second. And I want you to imagine a kindergarten class being asked the same question. How many hands are raised? All of them, all of them. There are a lot of smart people in this room. There's a lot of smart people watching this, from wherever they are. So presumably we all went to kindergarten, right? What happened? It's about incentives. We're incentivized as a child to demonstrate what you know. So you have an exam, you want to get a good grade on the exam, you demonstrate what you know on the exam, and then you can get a good mark. When you're going to university, you have perhaps an entrance exam or some sort of qualification exam and things like that. That's an opportunity for you to demonstrate what you know, right? When you get a job, you don't have a lot of experience, but you may have an internship, you may have your sort of academic credentials, and then you're demonstrating what you know to a potential employer. You have the job, and then you're ready for a promotion. You demonstrate to your supervisor, this is what I know. I qualify for this next position, and so on. So what happens, and what happened to all of us, myself included, is we let what we know get in the way of what we can learn. And that's where it relates to AI, is recognizing that we don't know everything. We have some of the sort of foundational material, but we can't make assumptions and let what we know get in the way of what we can learn. It requires imagination to kind of say, okay, this is what are the possibilities, and then perhaps work backwards. Zanna may be seeing it sort of a Bayesian tree, right? In terms of like work backwards of all of these different possibilities. What's likely to happen? Why would it happen? What's sort of structural about this when we think about risk? Those questions are sacrosanct, right? So just, I know we have the time ticking, so I just want to sort of land the plane here. We at S&P, we've launched a website purely for educational purposes. It's all free. So this QR code up here will give you access. And for everybody on the line, if you don't have the QR code, it's just spglobal.ai. The point is what we call a conversation with the market, right? So we're thinking about, as Zanna mentioned, sort of a portfolio of technologies that incorporate AI, right? So then machine learning, large language models, computer vision, the metaverse, all of these are technologies that in and of themselves create new opportunities and then bring some risks, right? Then we have what's called applications. So that's the industrial use of these technologies. So things in terms of banking with anti-money laundering or fraud detection, things in terms of real estate allocation or material sourcing and processing for buildings and engineering and so on. The use of the technology brings opportunities, and then it creates some risks, right? And my hope is, and this is the last section, is that once we have a conversation about this, and by the way, there's an accompanying podcast as well where we're bringing in outside industry experts to talk about these opportunities and risks, so we can really enjoy this sort of conversation together, learn, put all of these sort of risks on the table, and have a really mature dialogue about what are risk mitigant strategies, what are governance processes needed to sort of abate some of these things. So that way we can enjoy the fruits of a lot of this development in artificial intelligence technologies while mitigating the risks because they're deep on both sides. So, excellent.
Thank you.
Of course.
Thank you so much. I think it's important to broaden our horizon in this way and open new doors. But I'd like to still not let you off the hook so easily and pick up a little bit on, you do a lot of work in emerging digital threats. So what are the key components when you think about AI or new technologies?
Yeah.
What are the key components that we should be thinking about? You mentioned governance, risk management. Like, how should we think about it in a structured way?
Yeah, I think a lot of them are basically systems thinking, right? So in terms of saying, okay, there's some technical systems, and then there's sort of deployment strategies and what have you. I think it's easier to work back to front and think about what is the purpose of my organization, who are either my customers that I'm serving, who are the stakeholders. How do you sort of quantify, if you need to, I guess, but how do you sort of value this concept of trust, right? If you lose trust with customers, you don't have a business anymore. That could be existential. So in the credit ratings perspective, that's equivalent to the dirty default word, where it's like if you don't have a business anymore, you can't operate. It's not something you can manage anymore. Governance, I think, means all the world of a difference in terms of connectivity between different participants in the organization, other organizations, the supply chain, having open chains of communication. And actually executing on it for sort of deeper conversations about what is the risk, what are we trying to protect, first of all, what is the risk of not doing so, and what is sort of the relative priority of and importance, because we have limited time, right? So it's sacrosanct to really have that conversation and to really think deeply about, what am I doing, who am I serving, and starting with that.
Okay. So let me be a little bit mean almost, and I want to pick up on that, because you mentioned a lot, right? Ultimately, for a lot of firms and in the financial sector as well, it is about trust with your customer. It's a basic of your business model. The question I want to ask you, coming also from the industry, but having been close to the regulatory policy world, to what extent can this kind of risk and threats be really addressed through market forces? To what extent do you need a sound regulatory framework? And if so, what are the areas that are most important to capture in your view, or some of them?
Right.
We're still learning. We're all learning.
We're all learning. Yeah.
Right. Well, I think the real answer, the 30-second answer is it depends. There are some areas that I think that policymakers are traditionally concerned about, which are actually being mitigated by market forces as we speak. For instance, on concentration, people worry a lot about there being one foundation model, but in the past couple of years, we've seen vast improvements in scalability, in efficiency, which mean that there are lots of new, smaller models that do almost as well, and that's purely market-driven. There's been a lot of innovation. European AI Startup Tracker has over 1,200 AI startups in Europe alone. So it's a very dynamic market. So it's important to keep abreast with the changes, but it's also important to kind of keep seeing how market forces are still playing out. In terms of I think you have certain critical threats to financial stability, again, like, credit risk, kind of systemic failures of other kinds. And it's important to work back for very direct and specific ways in which a threat to that could arise to where the technologies come in, and not kind of go from the technology and whether or not it could pose a threat, I think.
So having a very risk-based approach would be the way
and specific and risk-based, I think.
Okay. I think it is time to go to you, Robin, and to hear from you.
Thank you.
Yep. Do you have some slides?
I have a few slides.
Very good.
Thank you very much. It's an absolute pleasure to be here and an honor to be among such an esteemed group of panelists. I'm going to start with a few main points. So I think the first important point to emphasize, and some of my fellow panelists have already said this, is to emphasize that AI is not new. And I'm going to borrow from the phrase that Olli Rehn mentioned earlier this morning, which is that we're in an evolution and not a revolution. And that speed of evolution may be quickening, and that's fine. But I think it's really important to understand that AI, at some level, has been with us for a while. Now, Jean mentioned that one of the challenges is that there are different definitions of AI. So I think it's almost like, at the beginning of every conversation, it's important to define what we mean by AI. And I'm going to borrow a definition from a 2022 paper by Danielson, McRae, and Uthman, who basically said that AI is the use of algorithmically generated information to make decisions. And so in my remarks today, I want to focus on that aspect, how AI is potentially being used to make decisions and what we need to think about in terms of those decisions. I think one of the key things to understand about AI is that in a lot of cases, there's a need to define precise objectives. And what that means is that there's little room for strategic ambiguity. Now, sometimes that's the case when we talk to humans as well. They like precise objectives. It's very difficult to think about ambiguity, but our role as regulators is to think about that ambiguity, and especially when we're thinking about systemic risk. So it's important to understand that AI is not necessarily going to have the answers when we have highly ambiguous, highly uncertain situations. Now, one of the first things I've been thinking about recently, and this is kind of an existential thought, so to speak, is this question of AI versus human. And I've been speaking to fellow academic colleagues and other colleagues about this question. And I haven't yet come to a conclusion as to whether this should matter to us. I think at some level, again, if we want to think about this in terms of the input to a decision, when we have inputs, when we receive information in making a decision, what we care about is accuracy and reliability. And one of the things that was mentioned earlier is that, in some ways, I think Jean mentioned that we need to benchmark our assessment of the use of AI to human decision-making, which also has flaws. And so at some level, when I receive information or an input, doesn't necessarily matter how it was generated. What I really care about is that accuracy and reliability so that I can have assurance about using that information going forward. I think the other thing that Sudeep mentioned was this concept of trust, and I think that's something that I've been very interested in thinking about artificial intelligence. So there's a large literature in the academic space on the distinction between initial trust and the development of trust over time. And particularly one of the things that this literature emphasizes is that humans are slow to trust algorithms, but then once developing that trust, tend to trust it more blindly or more completely, and possibly to trust it for having inputs or helping to make decisions beyond what it was initially trained for. The opposite of that is that the loss of trust in algorithms also happens very quickly. So once faced with an algorithm that makes some kind of mistake, humans would tend to abandon it completely. That's very different from how we interact with human inputs into our decisions. So I think that's an important thing to think about. So what is it about humans versus AI inputs that we should think about? Or what is it about AI that causes consternation? And for me, that comes down to three things, which are scale, scope, and speed. So one of the things is, with respect to scale, with the advent of AI, or with the advent of the new tools we have, because again, AI isn't new, but with every new tool that we receive, we can do more often, and quicker. That's the scale, scope, and speed, which turns out to be great if it's working well. It makes us more efficient. It allows us to do more with the limited time that we have. But it also runs the risk of it has the potential to amplify risk if it's not working well. Again, Olli Rehn mentioned this morning the increasing speed of the system being a challenge for timely risk assessment. And so I think one of the things that we as supervisors need to embrace is the possibility that AI tools may help us to do some of that risk assessment in a more effective and more efficient way. Which brings us to existing regulatory tools. So when I was thinking about what some of the concerns we have are about this new world of AI, I think one of the things that was mentioned earlier in the panel was this complexity of AI. We have a model black box. But as Jean mentioned, that we've been dealing with regulatory oversight of models for a long time. And so that need for oversight governance still exists. Another thing, I think Jean called it homogeneity, or sorry, Andrea called it homogeneity, but concentration, right? So what happens when everybody's using the same model as an input to a decision? Again, that's something that at some level, the models may be new, but the concentration isn't. And when we've in the global financial crisis, when there were model inputs, we had concerns over everybody, for instance, using the same credit risk model. I think those concerns are very similar in this context. Third is the interconnections, okay? Certainly these models interact with each other in ways that we may not understand. That's still similar to the interconnections and the concerns we have over interconnections already. The fourth is the excessive trust, okay? And I do think that's a concern. How do we make sure that we have oversight and governance in place to ensure that there is some accountability and responsibility for the use of inputs into our decision making, again, whether that's human or AI related. Now, I think it's important also to emphasize that it's not just about concerns. There may be plenty of uses for AI in the financial sector that may actually help us to improve the better functioning of the markets. And President Lagarde mentioned yesterday the notion of price discovery. That price discovery may be quickened with the advent of some of these new technologies. So just to close my remarks, I want to focus on the role of public perception. And this goes back to the unknown unknowns that Claudia Buch mentioned earlier yesterday. At some level, by definition, I think, the most dangerous risks are those we're not focused on, right? And there's plenty of risks that we're monitoring and we're certain of, but it's the risks that weren't on the radar, that have the potential to be catastrophic. Now, Jean mentioned the conversational tools, and this past year, we have seen, especially in the popular press and in popular perception, a ton of focus on large language models and generative AI. And so I wanted to close with this very nice chart from the EBA's 2023 summary of results from the risk assessment questionnaire. I'll mention that they have a similar chart in 2024. For some reason, they changed what the chart looks like, and so it wasn't as it's not as nice to interpret. But the results are roughly similar. So don't think that in the past year things have changed too much. The things to focus on here are the final column to the right. All those dark blue boxes basically say that 30% or more of the respondents said that they're not using and not planning to use AI tools in the context of the different categories that are on the left. And I apologize that it's so small, but there's a lot of categories. For the rest of the chart, the thing to look at are those light spaces. Okay, and those light spaces basically illustrate that only between 0 and 10% of respondents are using these technologies for the purposes that are listed here. And the key thing is that if you look, for instance, in column D, which is right in the middle, under natural language processing, that's not what the financial services industry is really focused on, at least in using it for decision-making into these processes. Everybody may be using their favorite tool for helping to write emails or other things, but they're not predominantly, that's not where the focus is among the banking sector. So I think I'll end there. I think the main point is, let me just emphasize, so far we're not seeing widespread adoption, but there is lots of exploration and a lot of excitement over the potential of these AI tools. My personal view, lots of regulation isn't the answer, but I think it's important to be involved in a discussion of responsible use. That's something that we at the Kogat School of Business are very focused on with our students in thinking about how do we embrace new technologies in a responsible way, which means being aware of both the benefits and the costs of these new technologies. Thank you.
Thank you. But Robin, thank you very much. Also, this difference, like very much the AI versus human, all the way to the perception. I will come back to it. So in your view, am I right? You don't think it's wishful thinking that AI could actually ultimately help us reduce systemic risk? How do we get there?
I think it potentially can, and that's a question that remains to be seen. It goes back to It goes back to the extent to which we exert and monitor appropriate controls and governance and oversight. We can't lose sight of that, and it comes back to this question of how do we handle the unknowns. Claudia Book, as I mentioned already, mentioned the need for a framework for this, and I do think we have that. But again, I don't think it's special to AI.
Okay.
So I think it's important to think about how we can use AI to improve our tools as well. In fact, one of the, more than 20 years ago, I became interested in large language models when confronted with these massive supervisory reports, where, as people were saying earlier, how do we distill that much information in a short amount of time? And one of the things I've seen in my own research is that the use of large language models to extract things like what's the most significant concern in this passage of text. There's literature that demonstrates that some of the large language models are better at extracting those most significant concerns than a human. And so being able to quickly distill large volumes of information to then identify the risks in a quicker way that then can allow us to address it, I think there's a lot of potential and hope for that, and I'm very excited about that possibility.
Yeah, no, absolutely. In fact, there's a lot of work being done also. How do you attract information and use it into risk metrics, for instance, in very difficult area like climate disclosure areas. Before giving the floor to Dirk, I want to touch base. I really like that idea or the thought you brought up about public perception, and maybe go to Sudeep. What, public perception and this the risk to potentially have excessive trust in the machine. Is that something you have seen, you come across?
Yeah,
something you worry about?
It's something I definitely worry about, and fortunately with my team at S&P, one of the areas of our focus is on these metacognitive processes. So like, how do you have critical thinking skills? How do you basically essentially have these sort of mental barracks that you can train in, that once you start seeing things in the field, that's not the first time you've ever seen it. You can build sort of that analogy, which I think comes at critical thinking skills and so on. I think that needs to be extended, frankly, in terms of with education systems and things like that. We had a nice conversation yesterday, a brief one, about some of these. If you look at teams in various either corporations or governments and things like that, everybody needs an increasing variety of skills and an increased diversity. And I think a lot of people of different walks of life and things like that bring something very unique to the table. And I think we're kind of recognizing that it's not just about policy. It's not just about sort of the technical. It's about learning and learning how to learn first. And I think that that's some of the secret sauce, I believe, which would help sort of mitigate some things around bias, things around sort of excessive trust in digital models that may be inaccurate because they don't have as much sort of relevance and so on. From like a decision tree perspective of mining data, sure, they're extremely good, but maybe it might be lacking in sort of the ethical component of decision making. And I think education and training in education, training in critical thinking skills is one of the most important things that you can do to sort of overcome that.
That's a very interesting humans versus machine. We need more diversity in the modeling of the machine, and we need more diversity in the humans working around the question. Thank you very much. I want now to turn to Dirk. Last but not least, tell us what you can tell us from a legal perspective, which really provides the framework for much of the AI discussion. Please come up.
Good morning, also from my side again. We deal with artificial intelligence for the most part from the perspective of fear of the unknown. And many people refer to the black box problem. I came across the term black box in two different contexts outside of AI. The one is selection of key executives. They are black box. You never know how they respond. They never know how they react. And I have two kids, so they're also black boxes. What I want to tell you in this regard is we should not fear something because we labeled something as a problem that already exists. We should see what the peculiarity is. And peculiarity is that they don't respond, AI as such doesn't respond to the natural incentives that we have. We can people penalize, we can lock them away. So we need to find equivalence to exactly the type of incentive and sanctioning system to kind of rein in the systemic risks of AI. And this is exactly what I want to stress. Once you start looking at AI from a regulatory perspective, you know, first of all, that we don't know what it is, but second, we know that it is certain features which we know from fintech more largely. And only these type of features create the systemic risks. And this is why the ESRB deals with it. And in fintech, we have a traditional triangle of data, liquidity, software, and code. Yeah? Why? Because all of them have scale economies and network effects. And that means without these type of three features together, AI is not a problem. When I don't have liquidity, whatever the AI model does, I cannot make a profit out of it. I cannot run down the system. When I don't have the data, my AI will probably spill out very unfortunate decisions, let's say it that way, yeah? Because it's a data-driven analytical tool. And of course, when I don't have the specific advanced code, my AI will just be an algorithm that has some random features. Yeah? So to understand that three things like that are inherent in every fintech model also allows us to think about it more rationally when it comes to systemic risk. I already mentioned that the black box part is not what I'm so much concerned about, but more the outcome of what happens if data, liquidity, and software and code together are present and influential on our financial system. And that's, of course, the capital misallocation that comes with it, the concealed coordination of actions, which kind of may trigger unfortunate results for the overall system. So let's just say that there's a certain type of model with a very large potential for operational risk results. We know that operational risk is usually one-off very big hit, and that means it could bring down the financial institutions. And for that reason, we should be concerned about. And of course, the collusion, the silent collusion, rips apart every type of efficient market model that we have, because of silent collusions will lead not to the best information being embedded in the price, but the colluding price will be the one that is the outcome. So these are the reasons why I'm concerned. So it's not the technology, it's not the black box, it's the outcome that these type of technologies can achieve when put in the wrong context. And here, just be aware of it, that the size effects of AI are the ones that this regulatory forum should focus on rather than the technology as such. We already heard that regulators around the world focus on AI from entirely different approaches. So we have the tech approach, which is the AI Act in Europe. It's more or less unique because we ask someone to explain something that some people cannot explain. Yeah, we usually say impossibilium est nulla obligatio. That means when you have something which it's impossible, it cannot be a legal obligation. But here we cannot ask for explainability, but we nevertheless ask for it. What the purpose is, of course, we want to bring the people, the humans in the loop. We want them to take responsibility as much as they can, knowing that there are limits at what they're doing. So when I'm working in my FinTech National Center of Excellence in Research, very much with AI experts, and they just tell me, we know how we set up this code, but we don't know where this is going to, because the code is rewriting itself. So we know what procedures we gave to the code and what priorities. But of course, once we let this type of AI loose on a very large data set, we want it to do something that we cannot explain. Because if we ask it to only do what we already know, we will not find the hidden opportunities. So the very idea is to do something that you cannot predict. And so from that perspective, maybe our AI Act has certain limits in terms of efficiency. Then we have financial services approaches. Most of you will be familiar with DORA. DORA is outcome-oriented and process-oriented. It is not tech-oriented in the sense that it says you shall not deal with AI, but you shall think about the risk, rein in the risk to the extent possible, build processes that you deal with that, and eventually you have some responsibility, some accountability around the use of that technology. Again, Europe is here at the forefront. We have some similar examples in Hong Kong and Singapore. For the most part, the other regions are disclosure-oriented. So here, DORA still needs to come fully in force, even in Europe, but we will see whether it has some progress. I think it has some progress, in particular when it comes to the transparency of the use. So I found Robin's table quite nice. I know that, for instance, the Luxembourg CSF has just completed a similar study on the non-bank financial institutions. So we will have more and more knowledge about it, and that's good because we can focus on these processes more granular and get rid of this fear of AI and just see it as a protective part of the overall financial system. Then, of course, data approaches are extremely important because data is what an AI needs. And here I want to highlight one example where also my colleagues from the BIS have done a lot of work on, which is big tech in finance. Most of these are kind of data-driven approaches. And I just want to give you a number because most people have never heard this number. But the largest financial institution in the world in terms of clients has more than 1.6 billion clients. 1.6 billion clients, adult population of most of China, lots of India, lots of other countries. How is it possible? It's a data-driven approach. Of course, now pair these immense amount of data with a very able algorithm. AI is just an algorithm, okay? Very able algorithm, and you see what size effects are there. And that explains the Chinese data approach. They have kind of created a public data warehouse where all the data of Ant Financial are kind of now nationalized. You can think about that as from a political perspective and so on, but from its pure financial services perspective, it makes a lot of sense because you can clean up the mess if that giant Ant Financial runs into operational difficulties. So having control of the data may be one aspect also how we can model whatever operational effects these AI have. We can use something which I like a lot, because to the same extent that we have operational AI, we have auditing AI in the meanwhile. We have written a paper in 2020 where we said, well, auditing AI is as faulty as operational AI. Unfortunately, meanwhile, we have audited AI being screened by audited AI. Yeah? So there is this type of multiplication of layers of AI. But when you now start thinking about it, most of you have come here probably with a taxi. And none of you is a car engineer, I guess. So you trust the car without understanding it. Because we have so many processes built up around the car that makes the car a reasonably safe thing to do. And this is where we need to get with AI, that the different processes we have come to a probability of low incident. This is where we need to come to, and we're already on the way. Also, very interesting here, the competition approach, which we see increasingly. Here again, the European Commission is quite active. India has an interesting approach, Kenya as well, because they look at the capital flows going into AI. So they want to control where's the money coming from, always believing that who pays will eventually call the tune. Because this AI is not unbiased. These AI have all the biases in there that are in the society and in the funder's brain. So when you know who pays for the music, you know what type of tune we will eventually hear. And so we need to know that every human failure is also present in AI, and that's the only reason why maybe the analogy of AI is used. Otherwise, I would prefer advanced algorithms, machine learning, self-rewriting code, because AI is a misnomer. So we have some study which is related to that, which we have just submitted to the European Commission. And this is more about the size effects in finance. It's not really about AI, but in this regard, it came down to our insight that AI doesn't matter as long as it's small, as long as it's experimental. It only matters when it gets important. And here in FinTech, we know that the stage from too small to care to too large to fail could be a couple of years. And that means all the data-driven analysis, which Olli Rehn has mentioned in the early on, will probably not lead to the results. Rather than that, we need to go to conceptual analysis, contextual analysis, a different type of approach. And that leads me now to maybe my final point for today. When we think about where the prudential model is probably underdeveloped, then let's take a look at operational risk. Operational risk is basically a stepchild in finance. AI is all about operational risks. So I'm thinking here is something that we somehow need to link the current state of the financial regulatory system with the advancement that we have in modern type of algorithms dubbed AI. And so in this regard, I would encourage the ESRB and similar working groups related and around it, and also the ESAs, to somehow look at this new dimension of operational risk that is related to AI in finance. With that, I'm in the end, and I'm very happy to respond later to your questions. Thank you very much.
Thank you. Thank you very much, Dirk. And I was wondering, there's one area that you haven't touched upon. So on one hand, quite an open approach to AI. AI, one of the things that we're seeing, and it comes a little bit to the decision-making that Robin touched upon earlier. AI is moving, so Gen AI, the more technologically advanced part of AI, is moving to these AI agents, right? Where AI, you said code can rewrite itself, where AI is starting to, or Gen AI is starting to set itself up to take decisions without any human intervention. How do you see that development, and how do we think about that development?
Well, first of all, it's a natural response to a threat that we somehow try to understand it with features that are experimental in nature. And what we saw so when we started dealing with AI in finance in our research in 2018, 2019, we saw that these models have become ever more important, but first to create opportunities. So basically to find the best investment opportunity, to become rich very fast. And as soon as we had found out that these kind of opportunities came up, the discussion about risk started, and then entrepreneurs started to build these auditing AIs or monitoring oversight AIs. Yeah? So I'm thinking this is a natural development. I have to say we try to identify in our research ways to screen the efficiency of these things. Yeah? Because we know a human auditor has a certain failure rate. They usually go for a 95% probability window, and for that, if you have these, let's say, outliers on the Gaussian curve, you don't find certain incidents. Yeah? And so in the same way, there will be systemic deficiencies also in these type of auditing AIs, and it's a task of the regulators, a task of regulation to understand where these deficiencies are and how they come about. Usually one deficiency which is very obvious is data limitation. Yeah? When you don't have a good training pool for the respective AI, the AI will just not be operational. Let me use one example which is often discussed in the literature. Most AML AI is trained with an Enron data set, and the Enron data set is particularly outspoken in the type of language they used. So there are sentences like, let's really rip off these people. In a good organization, a good corporate organization, you would never find a mail like that. That means maybe the Enron sample is too outspoken to train a sensitive AI. So you need to go for more granular data sets, and there the problem of materiality comes up. Maybe you have, for instance, a large incident that led to a huge operational loss, and the origin is 4 or 5 years later, and your AI is just screening the last 3 years, so you cannot detect it. Yeah, and so that's something we are still at the infancy of understanding where the limitations of the models are. The good thing is we are aware of it, because I entirely second what was said earlier. Once we are aware of a certain risk, we want to understand more, we generate knowledge, and find some common ground where the balance between furthering innovation and mitigating risks will probably be.
Mm-hmm. So that's really interesting, right? Audit AI is a great progress and a great invention or consequence of AI, and really helps. But when I think about systemic risk, audit AI seems to me very exposed, right? You can look at it, but in systemic risk, one of the issues is you're suddenly faced with something that happens in the market, right? And then you need to be able to react quickly. And the question is, when you have these, and there's no human intervention, do you have enough time in the system to really react in a way that we see in the financial market, and why a central bank may need to step in, or in the market you may have to do so. That makes it more difficult, right? Audit is kind of something you can do ex post to see if it works.
I think we should imagine that technology doesn't need as much time as humans. So I could imagine that, for instance, we run this auditing AI every 2 weeks, just in the background. Yeah? And as long as the traffic light remains green, the algorithm stays on the market. Yeah? So this is something we need to get away from the idea that time is a factor in monitoring and oversight. We can go to basically real-time regulation with these things. Yeah? So we could basically now each and every second what algorithm is just entering into which transactions. I don't know whether I want regulators to do this, but the technical abilities are there because it will entirely shift the responsibility. Yeah? So they're terrible incentive structures if we move that way, but the technical ability for real-time regulation is there.
Yeah. I find that fascinating. Maybe it'll be good to hear possibly from Robin before we give the floor to the public. To me, speed is actually going to be very critical in this into this high technological advancement, right? And in my view, so it's a little bit to your point, AI is not something specific. Ultimately, isn't it just about speed, getting to get things so quickly? And it's interesting because if you look at financial stability, and much of it has been about building into the system some things that have allowed to slow down that speed. And now we're actually going into where it's not just T+2, T+1, T+0, instant, real time, and what are the risks there? Do you want to say something on this, Robin, on the speed and how AI brings speed and the impact on financial stability?
Well, I mean, as I mentioned, I think speed is one of the possible distinguishing factors of AI versus other technologies. But I mean, it's important to, back to Sudeep's example, going back to the 1600, at some level, every technology has been about improving efficiency, improving productivity, and getting more speed. So in that sense, maybe it's ramped up in this case, but that is where I think it's important for the supervisory community and the regulatory community to also embrace some of the opportunities with respect to speed, to have running in the background real-time monitors that can then inform human decisions in thinking about things. I mean, if I think about financial stability at some level, when there's a crisis, and part of financial stability is hoping there won't be, but when there is, what do we need? We need to be able to respond quickly and nimbly and flexibly. And so in some ways, having tools that can help with that is critical.
Yep. Whether you will still need some humans to make some decisions in the background is a really important question. But yes, Sudeep?
Yeah, no, I would add, just to kind of land the plane, right, in terms of where we started with Zanna's example of the self-driving taxis, right? That's how it works, right? It has all of this real-time telematics and telemetry instrumentation to enable that fast decision-making, and it's constantly training itself to help protect you. And with a lot of the advancements, not even just in self-driving cars, but just in assistance systems with anti-lock brakes and all these other kinds of stuff, it very much works the same way. So I think it's about what you can do and then what you should do in terms of prudence with whether that's regulation or even sort of technological implementation.
Well, and I think there's also just this issue of the potential for unintended consequences. And that's something, it's important that those unintended consequences don't spiral into a systemic event. I mean, the obvious recent example is the CrowdStrike situation. It's not just necessarily risk from threat actors. It could be something that's seemingly benign that then has the ability to be systemic quite quickly, and that's something that needs to be on the radar.
Very good. I want to open, yes, I see some question from the floor. Please, Stefan, and I'll get afterwards. Please, I do believe you have to say your name because it is.
I'm Stephen Cicchetti. I'm the vice chair of the ESRB's Advisory Scientific Committee. I'm on the faculty at Brandeis University. This is really fascinating. I could ask many questions, but I'm going to stick to one. I did love, by the way, we could play the same game with financial innovations that you did with health innovations, but we would start in the 13th century with double entry bookkeeping.
Yeah,
probably.
that's right.
So my question is actually about what's new here and related very much, Andrea, to your questions about speed. So if I think about problems with speed in finance, I think about algorithmic trading. I think about the flash crash of 2010. I think about changes in technology that led people to co-locate their servers next to the servers that were doing the trade matching, and that's been going on now for the better part of 20 years. So what are we seeing now that's actually new? Besides possibly just even a little bit more speed. I'm still struggling with what's actually, with the questions where you started, and I don't know that we have the answers yet.
Should we, yes, who wants to pick up? So pick up and then Dirk, yeah? Quickly, let's make short answers so we can get a lot of questions, yeah?
I'll give you some book recommendations in terms of some of this. So there's an emerging branch of AI called causal AI, which basically goes at this bit of sort of causal inference. Is why is something, as opposed to correlation. So in statistics, we always learn correlation is not causation. We never learn what causation is. And in terms of the speed of analysis and being able to kind of understand these sort of probability structures based on the nature of things, the cold calculating way that AI works is able to see things that you can't because sometimes your own intuition gets in the way, but it's able to kind of learn some of that stuff. And in terms of risk allocation, portfolio allocation and risk allocation and so on, it's not just looking at what you know, but it's also looking at fundamentally how would these things work, how would sort of contagion emerge and things like that, which is very much new. It's in development still in terms of causal inference in general. We're just starting to learn in terms of even in hard sciences and things like that, because you need to develop a lexicon to understand these things in terms of point and counterfactuals and stuff like that.
A mathematical approach to intuition.
Yes, yes, yes.
Dirk.
So in short, we overcome bounded rationality with AI. That's just the point. Yeah? So it's quite interesting that you mentioned speed. The algorithmic trading, I think about speed with the invention of the telegraph of the 19th century. Yeah? So we think of that, which is for some reason close to us, maybe because of your research in the last 10 years, algorithmic trading is there, flash trading and everything. But that's exactly the power of AI. There is an opportunity in the unknown. And overcoming bounded rationality is really where we are potentially heading when we treat it in the right way.
Okay. Overcoming bounded rationality. I think we still have a little bit way to go, but that's a really good. So I had a question, yes, in the back, and then yes.
Trevor Maynard, Centre for Risk Studies at Cambridge University. I'm a mathematician by background, very excited by AI. But I wanted to ask, have you considered AI job displacement as a cause of systemic risk? Things like civil unrest, poverty, mortgage defaults. Just to point out, the Industrial Revolution led to many real revolutions in the 1800s.
Yep. Great question. Who wants to pick up on this? Do you want to?
I'm happy to say a few words. Yeah, it is patently clear that there can be macroeconomic effects of job displacement. I think if you look at Hyun Sung's paper recently, it is an open question whether or not job displacement would occur, and to the extent to which it would occur depends on how much, how quickly we manage to retrain skills. So Google has been talking to a lot of the governments about investing in training and specifically kind of AI literacy, AI skills to mitigate the landing. And to be honest, it is important for the government to invest in the transition if we think that the technology will be transformative, yes.
Yep, very good, thank you. Dirk,
so
you want to add something?
100 years or more than 200 years after the Industrial Revolution, we see the wealth effect of increasing efficiency, correct? And this is exactly what I will also expect in the AI world. Increasing efficiency is always good because we reduce transaction costs, we have better allocation of goods. It's just better, more fair distribution. Everything that we want to achieve with policy measures can be done more effectively with lesser cost. That's good.
Yeah. The rise in welfare versus then the equality issue, right? How is it distributed might be.
Well, nevertheless, when we compare the 17th century with today, I think everyone would agree that we have a better distribution of wealth than in the 17th century Manchester time.
Very good, thank you. Let me pick up two questions in a row so I had one. Do you want to ask a question? Two questions or even three, because I'm seeing now it might give us more leeway to answer. Yeah, up front. And then
Thank you, Federico Signorini, Bank of Italy. On this issue of job displacement, I have a question basically for Ms. Kesh, which is the following. Among the tasks that AI is likely to be rather good at, there are tasks in the kind of professional or top intellectual works like clinical diagnosis or preparation of legal cases, etc., etc. And then this is source of an endless discussion about complementarity, substitution, whether people will become more productive or people will be made redundant altogether, etc., etc. Now, one such task is likely to be financial rating. What is so special about human intelligence that assures it of having a role in rating agencies in the long term? Will rating agencies still employ humans in the foreseeable future? And if so, how many, to do what? I'm sure you have interesting thoughts on that to offer, which might have a more general bearing. Thank you.
Great.
Yeah, and of course,
Great question. Let me pick up two. There was a question up here, and then we can, so everybody, yes, a mic up here on the second row, and then we have one in the back as well. We'll do the next round, okay?
Dimitri Tsomokos from University of Oxford. I would like to follow up Stephen's question, and if I add scale on top of the speed of collecting artificially generated information to make decisions, how do you assess the risks of coordination failures, which are the bread and butter of financial stability? And furthermore, again, due to scale, how do you assess the potential of disincentivizing to acquire privately gathered information when we consolidate at that scale data and information? Thank you.
Great question. So in the back, and then we'll go in the very back. Oh, okay, afterwards.
So I'm Lorenzo, ESRB trainee. And when I think of AI in terms of financial stability, two possible outcomes for the future come to my mind. The first is a scenario in which there will be several AI models in which the financial system will be well diversified. And the second is a scenario where the financial system becomes highly concentrated because everyone starts using the same model, which could be very dangerous, I think. And I would like just to know your point of view.
Okay, which scenario?
Thank you.
Great. So three great questions. Who can I give? So why don't you start?
Yeah, I could take a stab at the first two.
Yep.
So in terms of, and I've written a paper on this, it was presented at Davos this past year, on AI and labor, essentially. So the idea was, there's three, AI and labor tie in three different sort of ways. There's a replacement function where basically AI does existing tasks that humans currently do. There's an augmentation where humans and AI can work together, and then there's this concept of regenerative applications where AI and humans can do things that humans could never do before, right? And it's not augmentative in terms of being a portfolio of skills. It's these new things. And granted, a lot of these regenerative applications are still very much providence of our imagination. So in terms of on the credit risk side, right? If the analytics for credit risk was purely determined on quantified information, i.e. financial statements and so on, then you'd be right, in terms of like where AI can do all that probably quite a bit faster and more efficient and with better quality than a credit analyst just looking at that. At S&P, we have a concept called a management meeting, where we're able to meet with the management of a company, the CFO, the treasurer, and so on, and really understand sort of the spirit and the strategy of what they're trying to accomplish, which then enumerates some instinctive qualities, because humans are far better than AI at relationship skills and being able to kind of understand, okay, this person seems nervous, or the way they're speaking, it indicates to me that maybe they're hiding something, or maybe that they're they say, we have a strategy, and then they have sort of, their press release and everything else that then is evaluated, and that part can be sort of generated by artificial intelligence with unprecedented speed. That enables the analyst to then ask the question to say, okay, well, I've seen that you said this, and I look at your operation expenditures, and you're clearly investing money, but how does this work? How does this connect? And that leads to kind of unprecedented quality of a sort of true risk assessment because it's augmented by artificial intelligence and so on. So it's one of those things that, like, I think you have to differentiate human skills, which is very much relationship, being able to kind of understand the quotient of trust is very, very difficult to sort of ascertain in mathematical terms. But a lot of the other stuff is hugely better, faster by an AI algorithm.
So still a role for humans.
Yes, absolutely.
So I'll go to Dirk and then...
So let's be aware, when the car was invented, we had never safety belts, no blinkers, no brakes. The first car was running straight against the wall because no one thought about slowing down. It was always speed. Today we have car inspections, the traffic police, and everything. And this is exactly what we need to know about innovation. Every innovation is neutral. It can be disastrous or extremely productive. It's about the policy environment, the regulation, reining in the innovation and making sure it has a productive use to society. And we are right now of the stage where the car gets a blinker, because these are the audit AIs. And so we will slowly get there to find the good balance. But we shouldn't kind of sanction an innovation before we truly understand it, because only once we fully understand it, we know how to make best use of it to the benefit of society. And I'm entirely convinced that reduction of transaction costs, speed, and everything is very beneficial to the financial system. Just think of the trillions and trillions of margin money being locked up in the system. If we could really go to real-time settlement, how much we would free in terms of capital. So there's so fantastic visions related to the right use of all of these type of algorithms.
When you sit on the other end, sometimes it is pretty scary because someone at some point has to be at the end of it when it's systemic risk. But very good. No, I think this is really a very important. Anyone an answer to the question? Do you want to pick up?
Yeah, I was just going to
address the coordination.
Yeah, exactly. So
Excellent.
I wanted to address the last two questions: how to assess the risk of coordination failure, the concentration of models, and then also thinking about how to disincentivize private information. So, I mean, at some level, this coordination failure is again, something that regulators have been concerned about all along. If we think about when we moved to, for instance, central clearing or other kinds of things that required, even when we set up the European Systemic Risk Board, there was a coordination involved, and worrying about what happens if there's a coordination failure is something that's, I think, built into our DNA. There may be things that we need to think about specific to AI, but at least for right now, I think thinking about how to prevent or mitigate or identify potential coordination failures potentially fits into our existing regulatory framework. Same with the concentration of models, whether those models are AI related or credit risk models or things like that. We have existing mechanisms for thinking about that. On the how to disincentivize private information, I think that's interesting, and that goes back to what Ali Ren mentioned earlier today. I mean, I think it's important to emphasize that one of the roles of regulation is to deal with potential externalities and to facilitate a balance between the self-interest of participants, particularly market participants in our case, with potential social benefits of preventing things like systemic risk, of ensuring financial stability. And that is where, it's having organizations like the European Systemic Risk Board that are outside the financial sector, so to speak, means that we can ensure things like sufficient confidentiality or the use of private information for firms, but it still requires there to be some entity, and again I will say that I think the ESRB is perfectly poised for that, but there needs to be some entities where that data can be collected, warehoused, and analyzed in a more systemic and comprehensive way. And so I think striking that balance between enabling private participants to have access to and harness their own information while still sharing it broadly with folks that are really committed to ensuring the financial stability of the system is critical.
And Jean?
May I just add a small point on the concentration of models? So one thing that's interesting and important about a lot of the AI models that are being used, so by the way, I'm going to assume that you're talking about the concentration of models for a particular task. As mentioned, there's a lot of things going on. But for particular tasks, say credit risk, one of the interesting things with AI models is this concept of fine-tuning. The idea that you take a pre-built model and then you fine-tune it using additional data to make more responsive to specific circumstances that are relevant to the user. And I think that that's very interesting in the concept, in the context of homogeneity, because this fine-tuning is not just putting more data, different data in the same model. It's actually changes fundamental properties of the model to some extent. So if you have different banks, even if they take similar inputs, but then they fine-tune, which they're very likely to do, on different data sets, their models are quite likely to be somewhat different and mitigate the issue, even if the input is the same, which I'm not sure it will be.
Okay, thank you very much. Very, very helpful. So I have time for one more round of questions. So yes, the gentleman on the second, and then in the back, 2 questions from that side, and one, and then, all right.
Federico Cornelli, Commissioner at Consob of Italy. I have a financial market authority point of view. Of course, we are mainly focused on price formation and stock exchanges, trying to maintain them clear without manipulation, etc. So, and I share the Professor Zetzsche point of view and dasselbe Weltanschauung. So, three questions on. First, when we have earnings, inflation, or data coming out, artificial intelligence is so fast compared to human. So some of our stakeholders say they should provide the data when stock exchanges are closed in order to provide the human a chance to elaborate the data, and while the artificial intelligence is so fast. And the second is, sometimes we've seen impact on high-frequency trading. They have high-frequency trading, they act very fast. One of these make a mistake, move the prices, all the others follows, and we have a shock. Then the shock might last a couple of hours or a day, but we have severe volatility that day on that stock, on that asset. Third, in Consob we are trying to use artificial intelligence to counteract for our authority regulatory work, which is not easy, and we are now asking ourselves, what do we do when we go for in front of a civil court for to punish someone? Does the civil court we do not have a validation like the ECB does, for the example, for the IRB methodology. There's no validation, public validations. And the last one is, now should we have impact on asset managers? Now we have asset managers managed by human, and then we have ETF. You buy an ETF, you simply follow the index. Shall we have in the future artificial intelligence managers that should reduce the cost of financial products? Thank you.
We are now officially eating into our coffee break, so I will get in trouble, but I will allow for a couple of questions. Please make them concise. All right, so I had I had 2 questions there and the third, but very concise questions, please.
Thank you, Claude van Pach, Banking Supervision Luxembourg. I have a question. We are discussing a lot about having basically space for macroprudential policy. And my question is whether tomorrow we should ask for time for macroprudential policy. I'm hearing you on the speed, and I agree. Basically, our reaction function tends to 0. And so let me put it maybe a bit provocatively going forward. Should we have an artificial intelligence that screens upcoming decisions before they're getting implemented in order to filter out systemic impacts where we basically should move to yellow or red light? Thank you.
Great question. May take more than 30 seconds to answer. Great question. Yes.
Thank you. Again, one other person from Luxembourg Central Bank, Abdelaziz Roueba. I have a very small question related to what Steve Cecchetti said before, related to this high-frequency trading. And Zanna said that there are different technology. I agree with this. It's not completely a black box. There are mathematics there, some algorithm and physics, which is rational. The question is how to handle or to deal with the speed of this algorithm. Is it a space for regulation to limit the deviation from a normal functioning of the market, or it's may say we keep at the situation as it is, and the authorities have to react ex post through suspension, for example, of trading, which is usually late. Thank you, Andréa, for giving me.
Yeah, as long as it's a super sharp and crisp question. Thank you.
I'll try. Ian Golden, University of Oxford. One of my research groups works on AI and the future of work, and I'm puzzled by the response that, in 100 years it'll all be fine. Because if we're interested in systemic risk, we're interested in the politics and what's happening in the next months and years, not 100 years. And all the evidence I'm seeing is that it's hugely disruptive to jobs in the short term. It's particularly disruptive to the spatial economics and to incomes. That is leading and feeding political populism. So I don't understand why, if it's fine in 100 years, we shouldn't worry about it now.
All right. Thank you. I have to stop. I really have to stop. I'm so sorry. But I do, so a number of questions on speed. Why don't we just, each of you, why don't you just can pick up whatever question and a concluding statement at the same time. Is that good? Dirk?
Yeah, okay. Very simple. Stock exchanges never close in our today world. So I'm thinking having announcement windows makes sense so people know when the announcement takes place, but I don't think there's an end of a stock exchange anymore in our 24/7 trading world. You just trade and an MTF or something else. High frequency trading, I always have the tick rule in mind. Yeah, so there's a lot of research on tick rules and slowing down transactions and similar things. So we should further the research there. My colleague from Oxford, I can just say the car was disastrous to the horse trader. Yeah? So that's what I just say. Innovation is always harmful to someone and beneficial to others. So that doesn't mean we should not innovate. Counter AIs, really a problem because our civil procedure rules assign the probability assessment to the judge and not to the algorithm. And so we shift now the probability assessment to the algorithm. And there we need some adjustment. We do a lot of work in that in the field of crypto because there are, again, the transfer of ownership is probabilistic in nature. So there will be a lot of adjustment necessary to follow that innovation. My last point, time windows for regulators, AI, yes, of course, to some extent, regulators will rely on AI, and that will enhance the speed of their response. And I think that's good, yeah, because right now you also rely on algorithms, and it's just a bit different type of algorithms.
Thank you so much, Dirk.
I will pick up on the jobs question briefly, because I do think it's an important aspect that possibly doesn't get as much attention as needed in a forum like this. So, I mean, I think the thing with jobs is that, as Dirk has mentioned, the job landscape changes all the time. And one of the things that I've seen with AI is that there seems to be an emerging polarization of, if I can categorize people, the people who are excited and want to embrace AI in whatever form and whatever definition that makes, and the people who are incredibly afraid of it and are afraid of technology or afraid of, and you know, what that means is that you have folks who worry a lot about this AI, however we define it, and recognizing that there are differences, is going to take my job. And I think, one of the things that we know from sort of labor force job satisfaction is that people like increasing autonomy. So if I'm a worker that has a lot of mundane tasks that an AI sort of development can help to do, that then frees me up to for instance, do more that employs my decision making or requires my oversight, possibly I will embrace that if somehow I can get over that fear of the technology. And so I think it's important just sort of societally to think about making sure that we have the training, and the information and the knowledge to help people understand how this is potentially, again, an evolution, not a revolution, and that it's important to recognize and think toward that changing job landscape, and then help to make sure that everybody is able to embrace the changing landscape in a way that lifts them up.
Thank you so much for this important point, Sudeep.
Yeah, we don't have time for a proper answer to the question, but I would. It's a very, very serious and a very important question that we all need to ask ourselves in terms of on the labor point in particular. All of them, but on the labor point in particular, I think this is something we should think about really, really deeply and really seriously. I will offer just a very small nugget that a lot of us can probably remember in the late 80s, early 90s, the development of the spreadsheet. The dialogue at that time was that the accounting profession would essentially die instantly, right? And the reality is there's no change in terms of the accounting profession. However, those who are using data information for their job, data analysts, financial analysts, all kinds of jobs, that has grown exponentially. So it's one of those things. Let's not lose sight of that. Phase change doesn't necessarily mean just elimination. It could mean no elimination, but then augmentation of new job families that don't exist.
There's a lot of unknowns.
There's a lot of unknowns.
You get the last word.
Yeah, one sentence. Well, so again on jobs, because I think it is a big picture question we should all be mindful of. I'm not sure there is much a systemic risk regulator can do to the extent that there is a displacement. Obviously, one needs to monitor macroeconomic conditions, and central bankers are, and that's fantastic. We don't solve the problem you described, even if it is a problem, through financial regulation. However, I think it is an important point for broader governments and policymakers to engage with the level of skills and the match of skills to the emerging technologies. And absolutely, this should not be ignored.
All right. That's a great final word in a conference of macroprudential policy. So a big applause for our panel. Thank you so much.